Corporate bonds and default risk. Corporate bonds are bonds issued by corporations. In U.S. markets, there were about $9 trillion of these bonds outstanding at the end of 2012. Investing in these bonds involves some of the same risks as investing in treasury bonds, but also an important additional risk that the issuer will go bankrupt and default on its debt. If that happens, you may be able to recover some of your claims if your creditor class is well represented in the bankruptcy proceedings. But you'll certainly face a substantial loss relative to the face value of the debt and the coupon payments that you were promised. Compare, for example, investing in a treasury bond to investing in a corporate bond. If you buy a treasury bond, you're buying a promise of nominal repayment. There is essentially no state of the world where your nominal repayment will be different from what is promised. But when you buy a corporate bond, you're buying a security that will have different nominal payouts in different states of the world. If the bond does not default, it will make nominal payments as promised. If the bond does default, then you will get something less than those nominal payments. To understand what you will get in these different states of the world, you should first understand that the debt issued by a corporation is a claim to the same underlying assets as the equity issued by the corporation. It's just that the debt has a pre-specified and senior stream of promised cash flows. A company is bound by contract to service its debt if it is solvent. It must pay the principal and coupon payments on its bonds and bank debt. Once it has done so, shareholders are the residual claimants. If the firm cannot service the debt, then it can file for bankruptcy in order to restructure its promises, where restructure here implies some reneging and some postponing of these promises. Now, I want to think about the market value balance sheet of the simplest possible company. It looks like this. On the left-hand side, we have assets. On the right-hand side, we have liabilities, which consist of debt, and then equity is the residual claimant. Think of this as a balance sheet with everything marked to market. That's quite different from the balance sheet that accountants use, since accountants tend to carry around a lot of assets at their original cost. The way to think about this is that the value of the firm's assets, A, is moving around with some randomness on a frequent basis. And it is that randomness that is determining changes in value in the firm's debt and changes in the value of the firm's equity. The firm's debt, D, is some fixed claim on the value of the assets. And the value of the equity, E, is what is left over after the debt has been paid. So if you have shocks to the value of the firm's assets, those will affect the value of both debt and equity. To take an example, suppose Solid Corp has an outstanding borrowing of $100. So bonds with a face value of $100 that are coming due in, say, 3 months' time. Solid Corp has a AAA bond rating. It is a high-quality investment-grade firm. It has $1,000 in assets, and its market value balance sheet looks like this. Assets of $1,000 on the left-hand side, liabilities here, D equals 100, and equity of the residual claimant at 900. In this case, D, the market value of the bonds, as well as the face value, is 100. D is almost surely going to get paid, as the debt is coming due very soon. And we're in a very low interest rate environment, too. So the market for bonds should be willing to pay almost $100 for this debt, maybe $99.99. Now, what happens if we have a $100 fluctuation in the value of the assets on the Solid Corp balance sheet? For Solid Corp, a $100 fluctuation in the value of assets will be reflected almost completely in changes in the value of equity. What do I mean by a fluctuation in the value of assets? Well, if the value of the firm's assets has a sudden big move due to some unexpected news, and these assets rise by 10% in value or rise by $100, then we will have E, the market value of equity, rising in value from $900 to $1,000, with D basically unaffected. And if the assets instead fall by 10% or $100, then we'll have E being worth $800, again with D basically unaffected. D is almost sure to get paid either way, so its value is hardly sensitive at all to changes in assets. Now consider Flimsy Corp. Flimsy Corp also has outstanding borrowing of $100, so bonds with a face value of $100. And suppose again that these are coming due in 3 months' time. Flimsy Corp has a CCC bond rating. It is a speculative grade firm. The traded debts of speculative grade firms are sometimes called junk bonds. Flimsy's balance sheet starts out looking like this. Unlike Solid Corp, its assets are only worth $100. On the liability side, its debt is worth $95, and equity, the residual claimant, is $5. The first question we should discuss here is, why would D not be worth 100 with E being worth 0? Well, if the firm were shut down today, D would get 100 and E would get 0. But the firm is not shutting down today. It is continuing to operate for 3 months. So equity is worth some non-zero amount because there's a chance that A will rise. And D is worth less than 100 because there's a chance that assets will fall before the debt is due. Keep in mind that equity has limited liability. Even if the debts are not paid in full, the value of shares in a company can't go negative. Consider now what happens if the market decides that Flimsy Corp's assets are worth 10% less than they were previously. Well, the exact market value of D and E depends on how volatile the assets are, which determines how likely the value of the assets are to recover to be more than $100. I haven't given you enough information to figure out exactly how much the values will change, but we might well see something like this. Assets going down to 90, and then the value of debt going down to 87, with equity being worth 3. So $2 came off of equity, which fell from $5 to $3, but most of the dollar value of the $10 decline in assets was borne by debt, which fell in value by $8 from 95 to 87. Note that this is not an actual default event yet. This is just the bondholders reacting to the fact that default risk has risen. It now seems less likely that in 3 months' time they will get their entire principal of $100 back. So, if you were an owner of the Flimsy Corp bonds, you would see a substantial fall in the value of your bonds to reflect the greatly increased risk that the face value of the bonds will not be repaid. And unlike Treasury bonds, those bonds are not necessarily going to recover to be equal to their face value of 100 when they mature, which in this example will happen in 3 months' time. For example, if the value of the assets is the same in 3 months as it is today, $90, then your bonds will end up being worth $90 at maturity, and you would see a 10% loss relative to face value. Equity will be worthless. Your bonds will not be worth $100 at maturity. The assets aren't there in the firm to pay for them. A riskless bond would be guaranteed to be worth $100 at maturity, but a corporate bond is not. So that is default risk. The closer to the default boundary the firm is operating, the more that changes in the asset values will be reflected in the price of the debt. We've seen that the debt issued by a corporation is a claim to the same underlying assets as the equity in the corporation. A corporate bond can't mature at a value that is above its face value, but, unlike a treasury bond, it can default, ending its life at a value that is below its face value. Defaults happen when the firm cannot or does not service the debt. That means meet the coupon payments or principal repayments specified in the bond contract. The sensitivity of the value of a corporate bond to matters specific to the particular issuing firm is going to be much greater when the firm relies more heavily on debt finance, like Flimsy Corp. In contrast, the debt of firms that are highly rated, or only use a small or moderate amount of debt, tends to behave a bit more like a treasury bond.